Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could in turn impact the positioning of our schemes. In the past few months, global environment has witnessed heightened volatility, largely owing to Donald Trump returning to power in the US. Proposed policies by the newly elected president aims to change trade, environment, and energy globally. The impact of Trump winning the US presidential election has been felt in Indian markets, with higher market volatility and vulnerable Indian rupee. It is believed that Trump's policies could be inflationary and derail the disinflation process, potentially keeping the U.S. Treasury yields elevated and U.S. dollar strong for a prolonged time. 10-year benchmark U.S. Treasury yield softened by 33 basis points, whereas yields of 10-year Japan bonds hardened by 13 basis points during the month of February 2025. The spread between the U.S. Treasury yield and Japan government bonds has contracted to 284 basis points, lowest since August 2022. We expect this contraction to continue due to the divergent interest rate cycles of the Fed and Bank of Japan. While Fed is in a pause mode till U.S. growth and unemployment remain strong, Bank of Japan is on its rate hike trajectory. U.S. federal official members continue to maintain their cautious stance while highlighting the sticky inflation and the uncertain environment. In the first round of tariffs, Donald Trump has targeted its largest trading partners, China, Mexico, and Canada, thereby impacting 46% of the U.S. trade balance. This could lead to a resurgence in inflation in the U.S., which has already witnessed some increase in inflation in recent months. Another key policy that Trump is propagating is the continuation of the 2017 tax cuts, which would lead to a significant drain in U.S.'s revenue. Policies related to trade and tax are pointing towards higher U.S. Treasury yields and stronger USD scenario, which could negatively impact emerging market EM countries like India. It remains to be seen how major plans of reducing expenditure pans out through Department of Government Efficiency, DOGE, which could lead to a lesser fiscal slippage. Foreign investors have been selling their U.S. Treasury yield holdings since 2019. The proportion of U.S. Treasury yield foreign holders to U.S. Treasury yield sovereign outstanding has been on a declining trend from 31.3% to 23.5% in the past 5 years. Foreign holdings of U.S. Treasuries fell in December 2024 as the two largest foreign holders of the government debt, Japan and China, both cut their portfolios. As per Treasury Department's data, Japan remains the largest and China the second largest foreign holders of U.S. Treasury yield. On a cumulative basis, till December 2024, Japan withdrew $265.7 billion since its peak in November 2021, $1,325.5 billion to $1,059.8 billion. China withdrew $371.9 billion since its peak in February 2019, US dollar $1,130.9 billion to US dollar $759 billion, till December 2024. The compression in spreads, 10-year U.S. Treasury yield, 10-year Japan government bonds, due to the divergent interest rate cycles between U.S. and Japan, has led to U.S. Treasury yield being sold by Japanese investors. This trend is expected to continue, and we may see a further compression in spreads. International Monetary Fund's real gross domestic product growth projections, U.S. economy is expected to cool off, while growth in UK and Eurozone is expected to pick up in 2025. International Monetary Fund lifted its forecast for UK gross domestic product growth in 2025, boosted by an increase in public spending announced at the autumn budget. CPI inflation moderated to 5.22% in December 2024 from 5.48% in November 2024. The reading also came in lower than the Bloomberg's median poll of 5.30%. Average inflation for Q3 FY25 stood at 5.63%, 7 basis points lower than RBI's estimate of 5.70%. Food and beverages inflation moderated to 7.69% in December 2024 from 8.20% in November 2024. Key components including cereals and products, vegetables and pulses and products, noted lower inflation in December 2024 compared to November 2024. In December 2024, the Consumer Price Index ex-food and beverages stood below 4.0% at 2.95% for the 16th consecutive month. Core inflation declined slightly to 3.58% in December 2024 from 3.64% in November 2024. Inflation scenario continues to remain uncertain with persistent price pressures from the food basket. The RBI has revised inflation projection for fiscal year 2025 higher to 4.8% from 4.5% earlier. As per RBI projection, CPI inflation is expected to reach the target of 4.0% only by Q2 fiscal year 2026. The 10-year G-Sec traded in a band of 6.66% to 6.72% and closed at 6.72% in February 2025, vis-à-vis 6.69% in January 2025. Sovereign yield curve steepened with short-term yields falling due to persistent efforts by RBI to ease liquidity, while longer-term yields rose slightly. 30-year gilt rose more due to the subdued demand from insurance firms and other institutional investors at the last sovereign debt auction for the financial year. At primary auctions, yields of 91-day T-bill, 182-day T-bill, and 364-day T-bill softened by approximately 11 basis points, approximately 7 basis points, and approximately 9 BPs respectively. Considering the AAA PSU corporate bond curve, the current spreads over sovereign up to 5 years tenor are higher than the long-term median spreads. This provides an opportunity to lock in at the current elevated yields of the corporate bonds. Gross domestic product growth improved in Q3 fiscal year 2025 to 6.2% from 5.6% in Q2 fiscal year 2025. While domestic investment scenario has weakened in the past 4 quarters, pickup in private consumption and exports largely supported the growth. Domestic growth seems to have bottomed out and should recover from here on, supported by the RBI through lower policy rates and continued liquidity injection. Consumer Price Index inflation moderated to 4.31% in January 2025 from 5.22% in December 2024. The reading also came in lower than the Bloomberg's median poll of 4.50%. Although there was an unfavorable base of approximately 11 basis points, the year-on-year reading decreased from 5.22% in December 2024 to 4.31% in January 2025, led by a sequential decline of approximately 97 basis points. Food and beverages inflation moderated to 5.68% in January 2025 from 7.69% in December 2024. Key components, including cereals and products, vegetables and pulses and products, noted lower inflation in January 2025 compared to December 2024 point. Core inflation slightly increased to 3.66% in January 2025 from 3.58% in December 2024. Inflation scenario has improved in the past few months, aided by a sharp decline in food prices. As inflation is expected to remain closer to the target of 4.0% in fiscal year 2026, it is likely that the RBI would continue with monetary policy easing. During the last month, US dollar portrayed continued strength, however noted marginal depreciation of 0.23% due to a sharp appreciation in Japanese yen as expectations built for continued rate hikes during the year. US and Japan have been on the opposite sides of the monetary policies, keeping the global currency market volatile. Indian rupee continued to remain under pressure and depreciated by 1.13% in February 2025. Indian rupee traded in the range of rupees 86.67 to 87.58 per US dollar during the month and ended the month at rupees 87.51 per US dollar. In terms of the 40 currency real effective exchange rate REER, Indian rupee continues to be overvalued above 100, however, has come significantly down from the recent high. Foreign portfolio investments were net sellers in equity markets, with an outflow of $4.0 billion, while debt markets observed a marginal inflow of $1.2 billion in February 2025. Due to excessive pressure on Indian rupee, forex reserves have come down significantly from the all-time high. In February 2025, however, forex reserves noted an increase of $10.9 billion and stood at $640.5 billion as on February 21, 2025. Liquidity conditions during February 2025 continued to remain tight. After infusing liquidity to the tune of rupees 1.16 lakh crore through cash reserve ratio cut in the December 2024 policy, RBI has come out with an array of measures including open market operation purchases, longer-term variable rate repo auctions, and US dollar Indian rupee buy-sell swap to provide further support of close to rupees 4 lakh crore. Banking system noted a daily average deficit of rupees 166,658 crore in February 2025, compared to a daily average deficit of rupees 201,951 crore in January 2025. Despite active liquidity measures by the RBI, banking system liquidity remains in deficit, and it is likely that the RBI would continue to take supportive measures in order to ease the pressure. U.S. consumer spending has shown some signs of weakness. Change in real personal spending contracted by 0.5% MOM in January 2025 compared to an increase by 0.5% in December 2024, while savings rate has shown a slight uptick. A slowdown in services, if sustained, may raise concerns about the resilience of growth within U.S. However, Fed members maintain their cautious tone, highlighting risks of inflation. The effects of Trump's tariff measures need to be monitored closely. It remains to be seen whether the steps result in retaliation by affected countries leading to trade wars, or whether Trump is forced to reconsider the measures. The effect on inflation in the short term, the medium-term growth outlook will directly impact global yields and their respective currencies. An important factor to watch out for is whether the tariffs will lead to a spike in U.S. inflation, or will U.S. growth pick up as intended at the expense of other countries. Tariff action by Trump seems to be causing short-term revert of money to safe haven assets like US dollar and US Treasury yield, supporting both currency and yields. However, looking past the short-term trend, US yields are likely to remain elevated, reflecting concerns about inflation, fiscal policy, and a possible prolonged pause in Federal Open Market Committee's easing cycle. US dollar is likely to remain strong as the rate divergence is expected to widen, except Japan. China's sluggish economy is expected to have support both from monetary and fiscal side to get its economy back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. However, developments related to U.S. tariff on China need to be monitored and its impact on the global economy. Japan, on the other hand, is on a rate hike journey, and the continuing unwinding of yen carry trades have affected yields adversely. Foreign capital movement away from Indian markets to better valued markets like China and strong dollar index have kept the Indian rupee under pressure. Further, while Indian rupee has depreciated steeply in the past few months, we are still overvalued compared to other emerging market currencies. The new governor, Sanjay Malhotra, seems to have signaled his willingness to allow the rupee to move freely in tandem with peers while still intervening to curb excessive volatility. With inflation moving towards the target, growth resilient though moderating, and with a rate cut widely expected at the next policy, the sovereign curve may have limited scope for capital gains. On the other hand, the corporate bond curve is providing healthy accruals up to the 5-year segment and has potential for capital appreciation. We maintain a bullish bias on the sovereign yield curve and expect the 10-year Indian yields to structurally move lower, though may remain range-bound in the near term. Even on the corporate bond curve, we maintain a bullish bias and expect the yields to structurally move lower. Further, while the corporate bond curve is currently inverted, we expect it to normalize over time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.